I believe Amazon is one of the easiest buys in the entire stock market right now. Trading right around $230 per share, I believe they are an easy double up, so 2x your money from current valuation today. In this video, I'm going to walk through why I believe that, talking about the fundamentals, talking about the shift that they're making with AI and robotics to make their e-commerce business even better and more profitable, and also getting into my value analyzer, where I analyze the company through, where I believe that it's what the fair value is on the company, through my projections, and also using some AI to help us analyze the company altogether. So without further ado, guys, let's get into it. All I ask of you in this video is, it takes me a lot of time to put these videos together. It's about to be Christmas. Make me a Christmas miracle. Smash that like button and subscribe if you want to see more content like this. So let's get into it. So we're over here on valuesnapshot.io. We're going to go over here first into the one pager, and we're just going to run a simple one pager through the site for Amazon. We're going to do an infographic, Amazon one pager. And then, like I said, we're going to get into financials, the charts, and then we're going to get into the analyzer, where I give you my inputs and what I believe that they're going to do over the coming years and what the valuation of the stock is today. So the infographic here has a strong buy on Amazon, currently sitting at $228.43. Bullish, 78 analysts are bullish on this company with price targets between $270 and $320, which is a massive move from today's price of $228. PE sitting right around 32, expecting a 10 to 11% growth rate. Free cash flow yield is 1.5% due to recent free cash flow hiccups, but I believe that's just due to the massive spend that they are having, and they're going to reaccelerate free cash flow into 2026 and beyond. Bull case, Amazon Web Services cloud growth remains robust. Zoom in here a little. Amazon Cloud Services remains robust, strong e-commerce market share, and high analyst target price. Bear case, increased regulatory scrutiny risks. That's for every Mag 7 company. Intense competition in retail. This is a moat. I don't really see too much competition outside of Walmart, honestly, and they're different fields. Lower free cash flow margins. Amazon is a strong buy with significant upside. That's just the meat and potatoes right there of the infographic. We're going to get into the financials, the charts, and everything in a minute. But I wanted to come to you real quick and tell you a little story. So the other day, I needed to burn a CD. Yeah, I needed to burn a CD. And it was for, this claim that I'm working on with Veteran Affairs and all this different stuff, right? So I need to burn a CD because it was the only way that I could get them my actual medical documents, right? So I need to burn it all onto a CD, which I didn't have. And I don't have a computer that has a CD drive anymore. So I went to Staples, I went to Best Buy, I went to Walmart. Nobody had one of those plug-in portable CD burners or CD drives or DVD drives or whatever that I needed. So nobody had it. I ran out. I was like, oh, just get it real quick. Nobody had it. So what did I do? I came back home. I looked on Amazon. I was able to get it delivered that next morning between like 6 and 8 a.m. That is a massive, massive moat. You can also get milk delivered for only a couple dollars, like that day. These are the things that Amazon has been working on to make it so you rely and need their product. And me and this family, we need Amazon. We need it for that 2-day delivery or sometimes the sooner delivery. We like some of the shows that they have and movies they come out with on Prime Video. And just overall, I mean, it's something that it's become a necessity in this house, to be totally honest. Now, I say that lightly, okay? If I really wanted to cut back and I really didn't need it, then we wouldn't have it. But it's a necessity for people that can afford it, right? That monthly subscription isn't too bad, and it's something that we can definitely afford. So it's something really nice that we like to have, and it makes life a little easier. So not just that, but like I was saying earlier, Amazon is giving you the full picture. It's giving you robotics, it's giving you AI, and it's giving you US e-commerce, which are three massive pillars that are going to continue to grow like a weed into 2026 and beyond. Okay. So I want to make that real clear, real quick. So now let's get into the actual financial charts. So we can pull up here, we can run Amazon, and I got this zoomed in, so that'll be good. Let's expand this a little bit. So we got yearly here. Yearly's doing really well, right? 32.9 billion free cash flow. We could look at the quarterly quick insights and we could look at the trailing 12-month insights. Let's for this video go with the quarterly and see where things are going on a quarter over quarter basis and over since 2022. So we could see that gross margins have kind of basically stayed in line, 42.6% up to 50.8%. So no, they've actually grown a decent amount since 2022. That's really good. That's what we want to see. Operating margin. Operating margin has continued to climb and now has fell off a little bit in recent quarters, but staying pretty stagnant up here into 2024 and 2025. Net margins have continued to go up and to the right. This is very good and what we like to see. 0.2% all the way up to 11.8%. And free cash flow margin is kind of basically just a big chop fest across the board. Now, why do I believe that the free cash flow margin rate, the net margin rate, the operating margin, and the gross margins are going to continue to go up, up and to the left? Why do I think they're going to continue to go up and to the left? Well, it's this tectonic shift that we're seeing with Amazon and their business that I believe is going to drive that bottom line in the net margins and drive them to more profitability. We are seeing now, I'll caveat this with I don't like the fact that anybody's getting laid off, okay? But it happens. It's part of life. And with these businesses, they're going to lay off people. They're also going to hire way more people than they ever lay off. So let's just get that over with. For all the people that want to attack me in the comments, oh my gosh, you're rooting for people to get laid off. No, I'm not. AI has was behind over 50,000 layoffs in 2025. Here are the top firms to cite in the job cuts. Amazon, though, is one of the biggest. Amazon in 2025, 30,000 job cuts and company's biggest shakeup since 2022. And then on we go with news of just cut 14,000 people in October and so on and so forth. And they are planning for more and more layoffs. They're planning for more and more layoffs at Amazon. Why are they laying off so many people? Well, Amazon is very dense. They're very dense with the amount of employees that they have. Why are they very dense in the amount of employees they have? Well, the only way I get a CD drive or whatever delivered to me next day in the morning is by having somebody to drive it and come bring it to me and having somebody prepare it at the warehouse to bring to me the next day, right? So you need a lot of employees at the warehouse. You need a lot of employees and delivery drivers. What happens when Amazon starts to sit there and now replace employees with drones, AI, and robotics? Then you give a one-time expense for drones, or robotics, one-time expense, and then you get to recoup that money through all the e-commerce business that you bring in. Compared to a normal employee, you have to keep paying in, month out, year in, year out, health insurance, benefits, all this different stuff. Once you get rid of that, right, and you replace employees with robots and AI, which we've all kind of seen coming. I don't know when it's going to come, but it's starting to happen now. I don't know when it's going to come in full force, but it's starting to happen now. So when you have that, you are going to see what we're seeing now. Massive layoffs from Amazon, massive hiring in one distinct field, empowering fulfillment through robotics automation. This is the jobs for Amazon, and we can go through here, and it has tons and tons of jobs for what? Robotics engineers, senior applied scientist, Amazon robotics process engineer intern, senior mechanical engineer, robotics. 9 pages of jobs all centering around robotics, not delivery drivers, not warehouse workers, right? And robots being these mechanical arms or these platforms that move around and basically pick up packages and deliver them and take inventory and all these things. Those are the robots we're talking about, not talking about like human robots walking around dropping off packages and moving things in the warehouse and stuff like that. No, the warehouses are going to be like they're going to have massive automation with big mechanical arms and moving platforms and all this different stuff, right? That's where we're going to see in the warehouses. That's where we're going to cut down on employees, and we're going to see, net margins continue to climb because these are more so one-time costs. And, yes, there's maintenance. Yes, there's different things. Yes, you still need employees, but overall, you're going to see these costs way less, way less than employees. Someone gets hurt and then you got to pay disability and all these different things. Okay. So we're seeing massive hiring in Amazon for robotics. And basically, like I'm trying to say is AI and robotics are coming full force to Amazon. They're making this tectonic shift away from a ton of employees into more robotics, more AI to drive that bottom dollar higher, to drive net margins higher. Because if they're able to do that, which I do believe they will, then you are going to see this massive appreciation in the stock price, like we'll get into here in a minute with the stock analyzer. You're going to see this massive increase in the stock price, a re-rating in the stock, because their net margins are going to go from, in the teens or in the single digits up into 20% or so, which is massive for the company and is going to, again, drive them to be more profitable. And just so you know, Amazon is probably going to be the first company to do $1 trillion in revenue. $1 trillion in revenue. Why? Because it's the company that's literally doing massive volume when it comes to e-commerce. It's just with the massive volume in e-commerce, they've been playing this game of let's get a bunch of people hooked to our product. Let's get a bunch of people to rely on Amazon Prime, give us a paid subscription like Costco, and then we give them so much value that they can't even pass it up, and then we'll continue to climb prices over time. They can keep climbing prices on Amazon Prime above inflation rate, so they keep making more money. And they're doing all of this while they are losing money on the e-commerce side. But once they make this flip into robotics, then they're not going to lose as much money. Actually, they'll gain money. So they'll start gaining money in this whole field, right? Why? Because they're going from massive employees, massive pay to employees, a massive amount of benefits and so on and so forth, to now having one-time costs, and they're able to eat those costs with robotics and write-offs and all this different stuff. This is what we are seeing. We are seeing this shift away from employees. And once the e-commerce business becomes profitable and more profitable as time goes on by replacing employees with robotics and AI, then we're going to see this net income, net margins, free cash flow margins explode. We're going to see them absolutely explode. So that's what I'm really seeing here. With this whole why I believe they can double in the next 2 to 3 years and why I believe they're, a steal deal today. So that's the profit margins. You have your net income and your revenue have continued to climb, right? Have had some hiccups here, kind of stabling out, but for the most part, quarter over quarter, 7%, three quarter average, basically break even, 5-quarter average, 5% up. So if we looked at the trailing 12-month or yearly, it's going to be up and to the right. Same thing with gross margins and operating profit. Same thing with EBITDA, cash flows. This is where they struggle. This is where they really struggle. And I would like to see this free cash flow do a lot better in the future, because right now it's just not doing that great. They only can highlight a couple quarters where they have massive free cash flow growth and where they make a lot of their free cash flow, and then the other quarters just suck. But I think, again, this is going to alleviate that. And we also have to understand they are doing massive spend due to AI, due to robotics. So we're seeing a capital expenditure spin up, right? They're just continuing to spend more money. This is every quarter. They're spending money every quarter, every quarter, every quarter. Operating expenses and R&D, these are both continuing to climb every single quarter. The balance sheet still looking really good though, with $727 billion in total assets over liabilities of $358 billion and shareholder equity of $369 billion. Cash to debt still good, $66.92 billion in cash and cash equivalents. Total debt of $51 billion. We'll round up. Shares outstanding, small increases in shares outstanding, and they basically have held them for the most part the same, which is good, because once this company does become way more profitable due to these things they're implementing, like I've been talking about, then we will start seeing them buy back shares, maybe paying out a dividend, giving more back to shareholders. And here's the EPS, continue to climb as well. And I think it's going to hit this like peak velocity here pretty soon as we see this tectonic shift. Book value per share, revenue per share, you can see all this different stuff if you come over to the website and check it out. So much you can see and really analyze the company with this. But let's go over to Value Analyzer. Let's type in Amazon and let's run our projections and let's call it a day and let's get off to the Christmas break. And then I'll catch you guys after the Christmas break and we'll go from there. And again, if you appreciate this video, do me a favor, give me a Christmas miracle, smash that like button. Just be kind today and pass it forward. Hit that like button and subscribe if you want to see more content like this. So Amazon, we can run a DCF model, an EPS model, a rule of 40, a PEG ratio. We could compare all four. I want to really just come in down here to the DCF model. I want to come down here to the DCF model for the next 5 years. I want to go ahead and get the bull case. The bull case is going to be growth rate of 15%. They keep free cash flow margins at 9%, discount rate of 10%, and they have a terminal free cash flow value of 25. If we run that, they are overvalued. But what did I say in this video? If you've been listening in this video, I've been talking about one specific thing. I've been talking about that this free cash flow margin rate of 9%, they are going to be doing 15, 20% in free cash flow margin rate. So let's just say that 5 years, trailing 12 month of that revenue, that's what they're doing right now, trailing 12 month. The revenue stays at, let's call it 12% revenue growth. And let's say they get up to, I believe with robotics and everything, during this 5-year time frame, they'll get up to an average about 20% free cash flow margin rate, and their terminal value should be about a 30. They sit usually at a 30 PE. They sit right around that for really this entire time. You can see current is 231 price to free cash flow. 5-year average is 77. So going down to 30 in 5 years is actually conservative. And I believe that, you could even give it higher, but let's just stick to this. So we made some assumptions here. This is what I truly believe they can get to in this 5 years, and this will be the average. We now see that we have a massive 115% undervalued stock. And this is how we go from a current price of $228 to a intrinsic value of $492, or a 5-year target of $683 with a 24% CAGR for the next 5 years. So every single year, you are getting almost 25% back on your money. Now, that seems crazy, right? But it's really not when you think about it and you think about robotics and AI coming in there and really coming in and replacing these margins. Because these margins, 1.5, 5.2, 2.52, have not been great. So yes, I understand going from this to 20 might be a bit extreme. Let's go a little less. Let's say robotics do come in, but they don't get them the free cash flow margins of 20%. Let's say they get them to 15%. So they get them to 15%, still a massive buy. Still going from 228, which they should be today, 369 value if you believe in these assumptions, in a 5-year target of $512, which again is over a double up from here today with a 17.6% CAGR every single year. Now that's running the DCF. We can also run the EPS. We can come down here We can go 5 years. We can select the bull case. And with the bull case right here, you see that we're 33.4% undervalued. We should be fair value $304.75. 5-year target of $490.80. 16% CAGR. Again, a double up within the next 5 years. And again, this is taking 18% EPS growth rate, which they've done 16% recently. 1 year is 11, and then 5-year revenue, 5-year growth rate has been about 18.3. So again, we're sitting here looking at this and saying, okay, they're doing 18% now, but you have to understand, if robotics and AI come in here and replace massive amounts of employees, that's going to drive net margins higher, which means their EPS is going to grow like crazy. If they start buying back shares and they start having a higher net margin and they start bringing in more money to their bottom line, you're going to see EPS growth rate absolutely explode, probably more than 18%. 30 PE, that's totally fine. 77 has been the 5-year average, about 30 forward, and then 32 is the current. Years projected 5. Like I said, you're getting a great deal here on this company, and it's an easy sleep good at night company. We can also look at the rule of 40. We can run all models if we wanted to. So if we ran all models, we can see that we still have our DCF model in here. We can adjust that if we wanted to. We'll just leave that the same. That's what I believe they'll get to. Let's just even say they only get to like 10%. Well, if they get to 10%, it's not updating. That's fine. EPS model, we got that right. Rule of 40 again, believing that they can go 12% revenue growth, and profit margin, believing they could hit probably about 15% profit margin. You have a moderate rule of 40. Let's say they can hit, if they would really need to get to 28% profit margin or higher, which they could definitely do. They could definitely do that. I think they said around 11% right now, from what we were looking at earlier. And then the PEG ratio, if we take a 32 and the EPS, if we take that to like 18%, slightly overvalued on the PEG ratio. But the thing about the rule of 40 and the PEG ratio, guys, these are more so for like super growth companies, like where you can't really value them on DCF or EPS yet. Rule of 40 and PEG ratio are more so used for companies growing at a very high clip, like Palantir and stuff like that. That's how you value those companies. With something like an Amazon that's more stable, that has been around longer, that has legit free cash flow and EPS and their net income positive, then you're going to usually value them based off DCF model and EPS model, just so you know. So that is what I'm seeing with this company, guys. That's why I believe Amazon is an easy 2X from here. I really do. I believe over the next 5 years, they are going to easily double, and honestly, probably more, and beat out the NASDAQ, beat out the SP 500 returns over the next 3 to 5 years, because of this shift that they're making with robotics and AI into that space and away from employees, right? They're still going to have employees, but they're going to massively reduce their employee workforce in place of AI, robotics, and drones too. We didn't even really talk about drones that much in this video today. But again, guys, that's my theory. That's my belief with Amazon. That's why I'm making it such a big position in my portfolios across the board. If you like this video, if you want to see more content like this, see me run more analyze more companies, run more projections, see the fair value, intrinsic values, run it financials, talk about companies like this, do me a favor, hit the like button, subscribe to see more, and comment below what stock you want to see next for me to run through the value analyzer. I appreciate all of you sticking to the end of the video. I love you all. Hope you have a great Christmas, holidays, whatever you celebrate. I hope you have a great time with friends and family. Step away from the markets, relax, and come back into 2026 a brand new person, ready to crush these markets and ready to get after it in your investing and trading journeys. Love you all. I'll talk to you in the next one.